The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The fear of missing out drives the stock market to its first record high since January. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld, and it's good to see you again, Romaine Bostick.
I'm glad to be here.
It's been too long. Let's take a look at this rally that is greeting Romaine Bostick on his return. As he said, we're looking at record highs on the S&P 500. We are above 7,000 on that index. If we stay here, we should be golden. You take a look at the 10-year yield right now, a little bit of a sell-off when it comes to the bond market, not spoiling things in the equity market, but still 10-year treasury yields higher by about 3 basis points. Volatility draining all the while. The VIX now trading with a 17 handle. We are below 18 on your volatility measure. It certainly helps that crude is also behaving itself as well. Brent crude now below $95 a barrel, though certainly much, much higher than where we started March.
Yeah, we're going to talk a little bit more about that volatility, but I want you to keep an eye on a key number, 69.78. That's the number to watch, the last record high for the S&P, and it's almost right on the nose of where we actually open this Wednesday. Now, optimism for an extended ceasefire, even if there is no tangible progress from negotiators just yet, but that optimism is strong, and it's also being reflected in the flight from the dollar, which is down against the bucket for an 8th straight session, reverting back to trading as a function of rates rather than fear, with hedge funds increasingly pivoting to more bearish bets. We'll come back to that in a second. But take a look at bonds, because they are increasingly pricing out the war risk premium, with yields across the curve rising here on this day. Aiding in that price sell-off, though, is a warning out of the IMF saying that the escalating scale of U.S. debt issuance, remember that? That's actually undermining the premium Treasuries have commanded, an erosion that will continue, in their view, to push up borrowing costs globally. But we do want to talk about the volatility, all the volatility stemming from the war. There has actually been one big net positive, and that's, well, if you're a trader. Blockbuster stock trading out of the big banks in the first quarter, with Bank of America and Morgan Stanley both posting strong trading revenue beats. The two banks, the last to wrap up first quarter earnings for the Big Six. Did I miss them all, Katie?
You did.
All of which benefited from the uncertain sentiment that prevailed throughout the month of March.
Yes, this was a good vol environment because we were close to clients, and those clients were listening to our content and evolving and trying to measure through scenarios, and that worked both in equities and in fixed income.
Morgan Stanley CEO Ted Pick there speaking. I was actually here for that, so I did not miss that.
Right. Yeah. It's just the other 2 days, but that's fine. You didn't miss much. The big banks are making money when it comes to trading. Maybe the Goldman FIC traders had a little bit of a hiccup, but let's talk about the volatility that benefited those traders. Behind me here, I have the VIX, that's in blue, and then I have the MOVE Index, which measures Treasury market volatility in white. And if you zoom in over there, you can see that during the month of March, over at the corner, that's where volatility really picked up, that big spike, of course, that we saw across asset classes. It wasn't necessarily just equities, and certainly if I put oil up there, it would be even more dramatic. But we've since cooled down. So that war premium that you were talking about, Romaine, it's also true when you take a look at the volatility markets and the sigh of relief that seems to be being breathed.
Quite a day here on this Wednesday afternoon. Russ Brownback joins us right now to kick us off to the close. Deputy CIO of Global Fixed Income at BlackRock. And Russ, this drop that we've seen in volatility, what is that telling us, particularly in the fixed income space?
Yeah, good afternoon, guys, and thanks for having me. And so, I think there's obviously a relief trade that's, running through the markets today, and a refocus on, what are we believe to be transcendent influences in the economy that really support credit quality, support margins, support earnings growth. And, when you get a shock to the system, like a geopolitical shock, like what's taken place in the Middle East, you can, sort of seek safe havens over the short run, but they don't derail, those long-term influences that are so powerful and that have driven markets through the uncertainty shocks we've had over each of the last 3 years or so. So I think it's just a resumption of these really powerful influences.
Is it too early, though, Russ? I mean, we'd be remiss in not pointing out not only the duration of this shock, but while there is certainly optimism and maybe progress underneath the surface, we still have not come to any sort of definitive agreement to end the war, and more importantly, to get the flow of oil and other goods coming out of the Strait of Hormuz.
Yeah, Romaine, I would agree with that. There's a tremendous amount of uncertainty about how this all unfolds. But I think under all the kinds of scenarios you could come up with, that might say disruption continues, it's not a big enough disruption to derail these other influences. I mean, you've got structural CapEx, it's CapEx super cycle, it's multifaceted today. That CapEx is being invested in productivity enhancements, taking what was already a productivity boom, inflecting it higher still. And I just think that these are just too powerful as influences today to be knocked, from their influential perch by, any of the kind of plausible outcomes that may unfold from here in the geopolitical realm.
So structural themes still in place here. Russ, I do want to get your thoughts on what we heard from the IMF, which Romaine mentioned, that you take a look at the IMF pointing to the increase in Treasury security supply, really compressing the safety premium that U.S. Treasuries typically have enjoyed when it comes to corporate debt, for example. They specifically pointed to that narrowing gap between the yields of, the top-rated corporate paper out there and Treasuries. And, I wonder how you're thinking about that from a portfolio perspective, sizing up, what a Treasury gives you versus, the top-rated corporate bonds.
So, I think corporate spreads are tight today, partly reflecting the technicals that you just alluded to, but also reflecting, really incredibly historically good credit quality. So, when you think about the issuance last year, it's as much a function of a lack of net issuance. So there was a large gross issuance of corporate credit last year. But when you factor out maturities, when you factor out interest payments that need to be reinvested, you had very little net issuance. So you combine very strong technicals and very solid fundamentals. And, I just think we just have to get used to an environment of tight credit spreads. But I would say the other mitigating factor, Katie, is that all-in yields are, near multi-decade highs. And so when we're thinking about the end users of our multi-sector portfolios, they're looking at the all-in yields. And when we can still put together, a very diversified, high-quality fixed income portfolio that yields 6 or 6.5% still in this environment, you can go lock in forward inflation swaps against that and get a 4% real yield. So it's an unbelievable environment from that perspective.
It's interesting, Russ. I mean, specifically on corporate credit. So what you're saying is, when you're investing, the thesis isn't that you're looking for spread compression. It's those all-in yields that, you think about these tight spreads that we're at right now, that's going to be the reality for a while.
Katie, that's absolutely right. And that's also true in terms of interest rates. So we just don't see a big directional interest rate trade. We think the entire regime that we've been in for the last number of years and will continue to be in, it's an income regime as opposed to a duration regime. And therefore, the right approach is to use as broad a toolkit as you can to harvest global corporate credit, securitized assets, and build them along those high nominal risk-free rates to put together that, really a portfolio that, quite frankly, we're very excited about.
Russ, always a pleasure. Russ Brownback, Deputy CIO of Global Fixed Income over at BlackRock, kicking us off to the close. In just a few minutes, as we kick you off to the close, we saw a sharp drop in shares of Live Nation and a big spike in some of its competitors, including StubHub and Vivid Seats. Crossing the Bloomberg terminal, a jury in New York, a federal jury in New York has ruled that Live Nation, the owner of Ticketmaster, illegally monopolized live events, ticketing, and amphitheater markets. Of course, this comes against the backdrop of that settlement by the U.S. Justice Department just a couple of weeks ago. Joining us right now is Chris Palmeri, team leader of media and entertainment at Bloomberg News. So, Chris, unpack this for me. I think it was back on April 8th, we had that news that the Justice Department, under the direction of the Trump administration, was effectively settling with Live Nation. But this trial was already underway. What did we learn today about what the jury found?
Well, this is significant in a couple of ways, one of which is this is the first example we've really had successfully of Democratic attorneys generals pushing back on decisions that were made in Washington, whether it was DOJ or regulators. We could see more of this. Some of the states have sued, for example, to block the Nexstar merger with Tegna, which already went through. It could potentially be used, say, in Paramount, upcoming merger with Warner Brothers. But this is significant from that deal. And if you're a concert goer like me, this is also significant. The DOJ settlement was viewed as another slap in the wrist for a company that's gotten many of them over the years. This could be we just still don't know where the judge is going to go in terms of remedies, but could represent a split up of Live Nation and Ticketmaster, as opposed to just these settlements we've seen over the years where, everyone gets like 25 cents or whatever for the ticket they bought 5 years ago.
Yeah, it's interesting looking at some of the details here. The jury found that Live Nation overcharged fans by $1.72 per ticket, very specific. Talk a little bit more about the remedy, though. You mentioned that, a breakup potentially on the table. Apparently, the judge is going to decide later on that. But what is within the realm of possibility here, Chris?
Well, that would be a big deal because Live Nation basically has three businesses. One is promoting concerts, one is marketing and selling advertising, and the third is Ticketmaster. And Ticketmaster has been a huge moneymaker for them. There are periods where they don't make money promoting the concerts. So if they were split up, not potentially great for Live Nation shareholders. Potentially good news, as you saw the stock market reaction for competitors, because Ticketmaster has really figured out over the years ways to really get a grips with these exclusive contracts with venues and that, as well as venues that Live Nation owns, and as well as big tours that Live Nation promotes. So really that strong hold that they've had on the business has been tough for competitors.
All right, Chris, really appreciate your reporting here as we watch Live Nation shares fall by nearly 4% on the back of those headlines. That is Chris Palmeri of Bloomberg News. We're going to continue to follow that story, but let's shift gears a little bit here, because in a world being reshaped by AI, Bank of America is a beneficiary, not a victim. That is according to CEO Brian Moynihan speaking on the company's earnings call this morning. And our next guest says that the same goes for his $15 billion commercial real estate operator, which spans the industrials, the government, residential, and entertainment sectors. Joining us live, I'm pleased to say, is JLL CEO Christian Ulbrich. Christian, great to have you with us. So let's start exactly there. I mean, how does the world of CRE interact with the world of AI?
Well, for the time being, it's a big driver of demand for real estate space, especially obviously office space. And then, as with any other industry, it's a big driver of productivity for JLL, and I'm sure also for many other companies within our sector.
And to that point, when it comes to offices, I mean, I'm taking a look at the notes that you sent over to our producers. And when it comes to a lot of these AI companies, maybe it's unintuitive, but looking to expand their physical footprints here, which markets is that particularly true in?
The biggest beneficiary was San Francisco over the last 2 quarters, and the second biggest was clearly New York. They are going across a couple of cities, but those are really standing out, as San Francisco is really impressive how much space they picked up over the last kind of 6 to 8, 9 months.
So, Kristen, when we talk about this idea of where new opportunities are, and obviously a lot of focus in the CRE space, at least as of late, has been largely tied to the technology build-out that we've seen. It is sort of the opportunity, the investment opportunity there, and for that matter, the longer-term revenue opportunity, more diversified than that? Is there more dispersion than just data centers and the ancillary tech?
Absolutely. I mean, when you just look over the last quarter, we saw more than 30% pickup in office investments into office buildings. Now, they are coming still from a relatively low base, but you show how this asset class is coming back. And you also see it on the leasing side, where the demand for office space is now up to the levels highest post-2019. And so this asset class is clearly recovering.
When we look at the cost of borrowing, particularly for new projects, and for that matter, whatever the return that investors are going to demand here, is that sort of in sync right now? And if not, are you expecting any sort of potential smoothing out of that, particularly now, knock on wood, that we might be getting some sort of resolution to what's going on overseas?
Yeah, it was clearly in sync before February 28th. You saw overall investment volumes picking up very nicely again. So the price of debt and the yields which investors are expecting were in sync. Now, if we see a further increase in rates, that will mean that prices will have to adapt. But for now, I would say we are still fine. And if that if that resolution on the war is coming relatively swiftly, I think we will be good. If it continues to be the case that we have that war going on, then we may see more increases in interest rates, and that will have some repercussions on the pricing of real estate assets.
Well, in addition to the uncertainty over interest rates, where they could go during this period, should the war persist here, just what are you hearing from clients, from investors in general, when it comes to the Middle East? Because you think about, the physical considerations of a war going on, obviously that has ripple effects.
Absolutely. Now, unfortunately, we have to get used to that we have those wars, because we have a war going on in Ukraine now for more than 4 years, which is obviously much closer to core real estate markets in Europe. When we go to the war in the Middle East, I think the biggest concern for the time being is the implications it will have on energy prices, and therefore how it will drive inflation, which then will drive interest rates. So people are very concerned. I mean, there's a lot of noise in the world, and we would all like to have much less of that so that we can focus on our businesses.
Have you mapped out some sort of sense of how elevated energy and commodity prices are, how long they will stay at those elevations, and the potential impact on business?
Well, I think that is very much dependent whether that is coming now to an end very soon or whether that will continue. But I think your base assumption should be that we will have elevated energy prices for quite some time, because obviously there's some significant damage being done by that war to some of the facilities down there, and that will have a longer-term impact. And therefore, I don't expect in our own assumptions that energy prices will come down to where they were before February 28th soon.
And Christian, before I let you go, I do want to stay global here and talk a little bit about the global office market, because we touched on it a little bit. When it comes to the U.S., you think about a lot of excitement right now around AI and the companies that power it. What are you seeing on a global scale, though, when it comes to sentiment towards the office space?
Yeah, what we are seeing globally, that the best spaces, wherever you go, whichever city you want to go, whether it's in Sydney, in Tokyo, or Paris, London, Frankfurt, but also in the US, you see that the best buildings are achieving new record rents. We are almost every month getting to a new record rent. There's almost absolutely no vacancy in the best buildings around the world. And there's very little construction going on. And so that trend will therefore continue. There's a very high demand from the most successful companies in the world to bring their people into the best spaces which are available in the markets they are active. So that has been a common trend now for several quarters, and we expect that to continue due to the lack of new developments taking place.
Christian, really appreciate you taking time for us. Christian Ulbrich there, the CEO over at JLL, as we continue to count you down to the closing bells, with the focus up ahead on Bank of America and on Morgan Stanley, which is trading at a record high on the back of their earnings. We're going to parse those reports with Ken Leon, Director of Equity Research over at CFRA. Stick with us. This is The Close on Bloomberg. Time now for our top calls, the big movers on the back of analyst recommendations. And we start off today with Cloudflare. Net, Piper Sandler upgrading to overweight with the price target of $222. The analyst calling the cybersecurity stock an AI winner to own, and says the recent pullback creates an opportunity to get involved. Those shares up about 6% here on the day. Next up, let's take a look at SolarEdge. Goldman downgrading the solar stock to sell and setting a price target of $31. The firm says current expectations are too sunny given the company's core end markets aren't growing nearly as fast as consensus expectations. Those shares down a second day for their worst one-day drop since November. And finally, Citi, RBC upping the price target to $139 from $121. It's keeping that outperform recommendation. The raise coming after Citi delivered its highest quarterly revenue in a decade. Those shares up about 2% on the day, third straight day to hold at their highest level since 2008. And of course, Citi isn't the only one out with earnings amongst the big banks. Morgan Stanley and Bank of America both reporting this morning. And our next guest says we recommend staying the course with global U.S. banks. Ken Leon, Director of Equity Research over at CFRA, joins us to talk a little bit more about this. First, let's start off with the trading revenue. Of course, not a surprise, but certainly something investors are embracing today, Ken.
Well, it's great to be with you, and certainly volatility led to record trading results. But really, across all the businesses, we saw signs of strength. We got validation, which I think not only helps the banks, but the entire equity market. U.S. economy, health of the consumer, credit quality, very good. Capital markets look to be good with a still very good pipeline ahead for this year. And a lot of conversations, as you know, Romaine, over the last couple of weeks on the alternative asset managers and private credit, and the CEOs for the global banks were very constructive about this industry.
Overall, a relatively clean picture that we've heard from a lot of them, at least the picture from the last 3 months, Ken. Look ahead for a bit, particularly when it comes to rates and what that does to net interest income, particularly if we continue to see a steepening of the curve like we have.
It's a good point. And most banks, except for Goldman and Morgan Stanley, they're about 50 to 60% of revenue comes from rates, net interest income. But the levers to make that work is a stable or growing U.S. economy, which boosts loan volume activity, even if rates stay where they are. So you really don't need a scenario of declining rates for net interest income to be better. When you get to Goldman and Morgan Stanley, about 20% of revenue, these are really the linchpins for the capital markets.
And certainly you saw net interest income was the fly in the ointment when it comes to Wells Fargo reporting yesterday. And you saw that reflected in the share price. But looking forward here, I do want to talk a little bit about Citi, because you think about the reaction. Romaine walked through some of it. I mean, at this point, the record run that Citi has had, what more is left when it comes to, how to sustain this momentum going forward, at least when it comes to the shares?
Yeah, it's a good question, Katie, because Jane Fraser, Chair CEO, said 90% of their multi-year transformation is over. So we can also see transparently their businesses that were realigned. And Citi has, about 65% of their revenue coming from outside the U.S. Versus its peers, 75% or higher. So there's a little bit of concern about global risk. But when you look at Citi, what holds up their international businesses is the #1 leadership in terms of corporate treasury transactions. Very low risk, high recurring revenue. They're also beginning to gain some wallet share in investment banking as well as wealth management, although much smaller than someone like Morgan Stanley or Bank of America.
And Ken, a couple days out from their results, I'm curious what you make of what we heard from Goldman's bond traders. Of course, a miss when it comes to FICC trading. Of course, we saw a lot of strength when it comes to their stock traders, the equity business. But, I mean, do you think that this was a one-off, or what did you make overall of what we saw in those figures?
Katie, each of these banks, generally they were positive, but they were kind of like all over the place on FICC, which for viewers is fixed income, commodities, and currencies. Those that were net positive had very strong commodities, of course, in energy trading. But the rates not making that call, or rates kind of staying where they are, was the weak area. I'm not too worried about FICC. What's interesting here is loan quality. Economy's good. We actually saw these banks reduce their reserves for allowance for bad debts, if you will, and the provision for new loan losses was very low. That is surprisingly a good sign for the U.S. economy. And I really like the dynamics for the alternative asset managers because these large banks are partners with them in terms of making that industry as strong as it's been for 30 years, with some concerns on the retail side for private credit.
All right, Ken, really great to get your thoughts at the end of the big bank earnings here. That is Ken Leon. He is Director of Equity Research over at CFRA. And Ken brought up, what we're seeing when it comes to commodity trading. Yeah. And Bank of America actually saw a 60% jump when it comes to their commodities unit.
Absolutely. And I mean, this is, I guess, the power of having a diversified business as well. We've talked a lot about that a lot. Sometimes it works against them, but certainly in the most recent quarter, it worked well in their favor.
Absolutely. Bank of America highlighting oil and gold. Now, coming up, we're going to be speaking with Victor Haghani. He is the founder and CIO of Elm Wealth, also co-founding partner of Long-Term Capital Management. This is The Close on Bloomberg.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld. Taking a look at these markets right now.
They're doing well.
They are
S&P
doing
at a
well.
record high.
Yes.
NASDAQ at a record high. The
Yes.
Russell I checked was only like 2 or 3 points away from a record high. What's going on?
Well, first of all, you're back.
Yeah.
You know, it's been a long several days without you.
I will take credit, you know.
And it looks like maybe, I don't know.
I'm bringing the good vibes, Mon.
Good vibes.
Yeah, sure.
You were in Jamaica. I feel like that's needed context. But, you know, there's a lot of optimism over ceasefire talks. Maybe that ceasefire being extended. Corporate earnings season is kicked off.
Yeah.
It's really nice in New York City right now.
Yeah.
Vibes are good.
The vibes are good, but of course, I mean, you know, some people are half glass empty people, like me.
Yeah.
I mean, when you look at the market volatility, when you look at a lot of concerns about structural issues, a lot of big IPOs coming to market that could pose, I'm told by somebody, an existential risk. What does that mean?
Well, someone is here to discuss it all with us. I'm very pleased to say our next guest says that he's swimming against the tide on U.S. stocks. His name is Victor Haghani. He is the founder and CIO of Elm Wealth, also a co-founding partner of Long-Term Capital Management. Victor, great to see you.
Thanks, Katie. Thanks. Great to be here.
So let's start there because, you know, I'm taking a look at your ETF. It's the Elm Market Navigator ETF, ticker Elm. And you're underweight when it comes to U.S. stocks relative towards the rest of the world. So talk us through that. I mean, what was the original thinking when it comes to that allocation, and you know, why sustain it now?
Sure. I mean, it's really straightforward that our asset allocation tries to reflect expected returns and risk of the different things we can invest in. So at a high level, we think about U.S. equities, non-U.S. equities, U.S. fixed income as the three buckets. And the long-term expected return of U.S. equities, given our current level of valuations, earnings yield, and CAPE and so on, is a very low extra return relative to treasuries. Non-U.S. stocks are offering a much higher return. And we're also in a pretty high-risk environment right now. The markets are volatile. There's a lot of uncertainty. Momentum was recently just flipped negative. And so when we put all these things together, it's left us underweight U.S. stocks relative to our baseline, overweight non-U.S. stocks, and overall a little bit underweight stocks altogether. And you know, we're ready to get back in, you know, if the risk levels kind of go down again, and to get more back to our baseline weight. But we think it makes sense for the current conditions. And
when you say risk levels go back down, like how far are we talking?
You know, not a huge amount. I mean, we like to use momentum as a proxy for the risk level instead of using VIX, 1-year VIX or 1-month VIX. You know, using something like momentum's a little bit more stable. And so we're not very far away from that risk level flipping, and that would have us buy just a little bit. But the real issue is that long-term expected returns of U.S. stocks are really low compared to safer assets. And that's not just our view, that's the consensus view. You know, you just type into an LLM, what are the capital market assumptions of 20 investment houses? And what comes back is 6%.
Yeah.
Well, 6% is only 1% more than 30-year treasuries. It's hardly anything at all. How much stocks do you want to own when that 10-year return is so tight to something that's somewhat safer?
Well, talk us through, I mean, what qualifies as a safe asset to you right now that you would want to own versus a U.S. stock, for example?
Sure. So nothing is totally safe, you know, and we've talked about this before, as you reminded me. So, you know, I mean, I hate to say it, and I don't want to sound unpatriotic, but you know, there's a risk in everything, and you know, U.S. Treasuries unfortunately are not risk-free, but they're a lot safer than owning Treasuries, and in particular, if you're a long-term investor, you know, we would actually say that for long-term investors that are focused on their spending power over the long term, that Treasury inflation-protected securities are probably the lowest risk asset, lower risk than Treasury bills, lower risk than fixed-rate bonds.
Right.
But all Treasuries have a very high chance of paying off, but they're not totally risk-free, but much less risky than stocks, and their risk is kind of less nasty, right? Because when stocks go down big, that tends to be bad for everything. It tends to be bad for our jobs. It tends to be bad for our friends.
Yeah, it tends to be bad for everyone.
For everyone and everything, yeah.
I do want to get your thoughts on a paper from the IMF, or a report from the IMF that we saw Wednesday, talking about treasuries and the premium rather that they have over, the top-rated U.S. debt, for example. We've seen a lot of the hyperscalers come to market, and they specifically point to the collapsing spread that we've seen between treasuries and AAA-rated corporate paper. So, when you think about safer assets compared to U.S. stocks, I mean, where does very highly rated corporate fixed income fall?
Not safer than treasuries for me. Maybe other people would disagree with that. I mean, I think if there's a restructuring of treasuries, there's a lot of problems in our economy. Treasuries also have some special features to them, such as they're not subject to state and local tax for individual investors. So, I wouldn't view treasuries as being being a riskier alternative than the highest investment grade credit. Of course, any company that issues debt can look really safe and nice at any point in time, but there's no guarantee that they won't become highly leveraged in the future as well. So, there can be supply-demand, technical factors that are tightening spreads, but for me, treasuries are still less risky than basically any corporate bond.
I do want to talk about growth a little bit. I mean, I understand the idea. Okay, you're looking at 6% overall on the stock market, and like you said, you can get 4, 8, close to 5% on a 30-year. But for those folks who are looking for a little bit more hyper growth, you've seen a lot of attention right now paid to some of the potential IPOs coming down the pike. Anthropic, SpaceX, companies that certainly in the private space have had phenomenal growth here. Does that not appeal to you?
No.
Okay.
I mean,
and I should point out, you founded long-term cap. What happened to you? What happened to you?
What happened?
Yeah, I mean, you seem very safe.
I became more of a safe. Well, that's what happens. You get burned, and you kind of, hopefully we learn. We learn a little bit over time. Yeah. But no, I mean, I don't want to take idiosyncratic risk. I want to I want to focus. I want to take risk in things where I believe and can see that there's some compensation for taking the risk. So stock picking just doesn't appeal to me because you're taking this idiosyncratic risk, which Harry Markowitz about 70 years ago told us should not really get compensated in a relatively competitive market. So I want to get the lowest risk per unit of return that I can get, and that has me very attracted to index funds and not wanting to go into sectors or individual stocks that are. Have
the index funds not been corrupted to a certain extent by a lot of the automated trading? I mean, you bring up Markowitz. I mean, is there a sense here that the markets are indeed efficient, or at least efficient enough in this current world?
Well, turning to the mechanics of index funds for a second, there's like a lot of dumping on index funds. There's not that many people that are standing up for index funds, so I'm going to put myself out there as somebody standing up for them. The mechanics of index funds are basically sound. So if we look at the biggest and maybe the best U.S. index fund, Vanguard's VTI, it's the total U.S. stock market, 7,000 stocks in there, 3 basis point expense ratio. And people say, oh, but, it has to do all this rebalancing, and, you could do so much better by not doing the mechanical things that it does. Well, VTI has 2% annual turnover, according to Vanguard. They're turning over 2% of their portfolio every year. So how bad, no matter what they do, how much could they be losing out with these 2% of trades that they're doing, with other people front-running them and trying to take advantage of them? Like, if the other side is making even 10% off of those trades, that's a very, very small return hit, and that would be a lot of profit to make from those small amounts of trades.
Victor, less than a minute left, but just to tie a bow on this conversation, talk to us about what you make of some of these index providers, index operators, seeking to fast-track IPO stocks into their indexes. You think about the upcoming SpaceX addition potentially to some of these indexes. Does that not, to borrow words from Romain, sort of corrupt the indexes a little bit?
Well, the indexes eventually need to own these stocks to be representative. And so people are worried because IPOs, there's a lot of literature that shows that IPOs have a bad performance 5 years after the closing price of the first day. And so it's like, oh gosh, we're going to put these IPOs into these index funds and they're going to drag down returns. And it's a legitimate concern, but it's not a huge effect. Again, all of these IPOs, last year we had $80 billion of IPOs on close to $80 trillion of market cap. That's 10 basis points. So even if those IPOs go down by 20% because they're going into the index, a couple of months sooner, which is a very implausible thing, we're talking about single-digit basis point problems with these index funds. So I think it's really just it's just much ado about nothing, is what I've been saying. That it just isn't. It's just not a big deal. This whole worrying about. No, we should be worried about the market overall, valuations. Maybe these huge IPOs are going to be a catalyst for the whole market going down. Maybe we're going to see less buybacks.
Less buybacks, yeah.
Maybe we'll see less buybacks as companies need to spend more on infrastructure and so on. And maybe all those things could be catalysts or causes for the market to go down. But the index fund mechanics around IPOs is something to not worry about at all. It's a red herring that's a distraction. Think about the overall market, but the way that they're including them or not including them is not a big deal.
All right, Victor, we got to go. We can keep talking. Do come back. Victor Haghani, founder and CIO over at Elm Wealth. We'll be back in a moment. This is Bloomberg. Shares of Hims and Hers up about 12%. This after the U.S. Health Secretary RFK said the FDA is looking to restore regulated access to 12 peptides. Norah Mulinda joins us right now for a little bit more. Effectively, this would be a reclassification of those peptides out of Schedule 2, which is effectively for like opioids and other strong drugs. So what's going on?
So essentially, this is telling us that the FDA is moving closer to revisiting its peptide ban. There is essentially going to be an advisory meeting set for some time in July to further discuss this. And the focus is really going to be about whether or not all of these peptides that have been in focus, these previously banned peptides, should be allowed for compounding again. So that's how you're kind of seeing the link here when you think about some of these telehealth platforms and biotech companies more broadly and why they're reacting off of this news.
Yeah, it's really interesting. And I mean, what does this mean for the space broadly? Because you think about Hims, obviously a huge pop today, not too much reaction when you take a look, at some of the GLP-1 providers such as Eli Lilly.
Well, if we talk about why this is good for Hims and Hers specifically, I mean, demand already exists in the market. We do know that there are a lot of health experts that are a bit skeptical about some of these peptides because they feel as though there's not been enough research done as to whether or not it's actually safe. But that being said, we do know demand still exists, whether it's on the black market or not. RFK Jr. saying that he thinks that essentially streamlining this will take the demand away from the black market. But we also know that telehealth platforms like Hims and Hers are positioned to scale quickly, and they already have peptide manufacturing capacity as well.
Will these make me look younger?
That I don't know. I mean, but you look great, so
you don't need
not a concern.
Got that Jamaica glow. Thanks to Bloomberg Markets correspondent Norah Mulinda. The closing bell is up next. This is Bloomberg.
A geopolitical shock like what's taken place in the Middle East, you can, sort of seek safe havens over the short run, but they don't derail, those long-term influences that are so powerful and that have driven markets through the uncertainty shocks we've had over, each of the last 3 years or so. So I think it's just a resumption of these really powerful influences.
Russ Brownback kicking us off to the close over at BlackRock just about 50 minutes ago, and at least for right now, nothing's getting in a way to disrupt what is going to be a record rally for the S&P and the NASDAQ.
Something could happen in the next 9 minutes, but at least for right now, the S&P 500 close to session highs, well above 7,000. The NASDAQ 100 also touching an intraday record high. You take a look at what is going on in the rest of the market. The fact that you're unchanged on oil and below $95 a barrel on Brent certainly helps the equation. The bond market pretty well behaved right now. A little bit of a sell-off. The 10-year yield higher by about 3 basis points, but certainly not near some of the levels we have seen over the past 6 weeks. And the VIX, we were below 18 a little bit earlier, but still an 18 handle. A lot of folks would take that, Romaine.
Yeah, and it raises a lot of questions as to what exactly is being priced in, Katie. Is this really about some potential relief with regards to the situation in the Middle East, or are people finding a more fundamental reason to pile in? Amy Wu Silverman joins us right now, equity derivative strategist at RBC Capital Markets, to count us down to those closing bells. And I guess that is the big question, is like how much conviction and momentum is behind this rally? Is this just basically just trying to claw back the losses from that sort of war-induced sell-off, or is there something more to it?
I'd say two things, Romaine. I think the tails, both the left and the right, are just fatter. But second, days like today are sort of the hedge when you can, not when you have to days. So folks I've been talking to for the past few months were complaining about the cost of protection being too high. You got your chance, but of course, what's kind of overtaking everyone is that fear of missing out, fear of that up crash, and I do think that momentum will probably continue a little longer.
Well, I am curious about the hedging side of this, and we should point out this isn't a broad-based rally. I mean, we're getting a big lift today from a lot of those kind of Mag 7 type names as well, and that might be indicative of where people's head is at. But do you think we will see a little bit more hedging, particularly given that there are still so many unknowns, not only about the duration of the war, but obviously the potential economic effect of what has still been, one of the longest shutdowns of a major supply route?
Yeah, to some degree we have. So when you look at what folks are doing in derivatives, especially on days like today, you are starting to see them initiate hedges, and some of them actually a little bit more long-term. We've actually seen investors be really tactical, really short-term, trying to play this like challenging, grinding market. And then days like today, when sort of everything is coming down, everything's slightly cheaper, people are willing to spend a little bit more because, to your point, there's a lot we don't know. There's a lot that is very dependent on how negotiations go, and certainly just earnings, just the fundamentals around that. But that isn't to say that there isn't serious kind of FOMO that I do sense building, and historically when you get that, it actually tends to get more positive momentum.
I was out of the loop, Katie, for the last few days. Didn't you send negotiators over there, like JD
We
Vance
did.
and the folks? What happened?
Well, they came back. They were empty-handed.
Okay.
The U.S. put in place this blockade of the Strait of Hormuz. Now we're talking about talking again. It's a whole thing. You didn't miss too much. But Amy, how long-term is long-term when you're taking a look at the hedges landscape and what is actually being put on and bought right now?
Yeah, long-term is always sort of, I guess we say that jokingly in derivatives because we consider long-term maybe 3 to 6 months. A year is like infinity. But look, it's interesting because when you think back to a few weeks ago when we were, much more in dire straits with a VIX that had surpassed 30, people, what they were doing was on sell-offs, they were actually monetizing their hedges so that you weren't seeing them deploy more. And then when we saw rallies, you actually saw folks selling volatility on that. And what that tells me is there was not that much conviction. Like people did not say, I'm going to use this to double down and further my hedges. What we're seeing today, I think, is really interesting because the hedges that are placed show slightly more conviction just in the tenors that are being deployed. The second thing I would say is there has been just more of this. I saw you guys had put on the Chiron the 3 big IPOs potentially that are coming. In tech, you're starting to see that volatility really look interesting in the queues and specifically in those names because people are focused on, hey, if I miss upside in that, I really miss it in kind of heavyweights.
Absolutely. I mean, we were talking about the impacts potentially on the indexes if we see those IPOs get fast-tracked, and certainly there's a lot of rabbit holes you could go down. But I do want to talk about cross-asset volatility a little bit because we kicked off the show looking at a chart of the VIX versus the move, and certainly you've seen that drawdown when it comes to bond market volatility in addition to the equity market. But what are we seeing when it comes to, options activity around, some of the more energy type names?
So it's interesting, as you would expect, there is more option activity there. So one thing when we sort of kicked off this whole geopolitical situation with Iran, some of the most popular trades, not surprisingly, would be call spreads in an XOP, that ETF, or XLE, or maybe specifically in the underlying commodities themselves. And a lot of that, while that has come in just with the overall decline in volatility, I do think people are looking at hedges today. Not only are they looking perhaps at S&P, put spreads or VIX call spreads, they're looking back into that complex and saying, look, I don't know if any of us are certain what is going to happen with negotiations, so maybe we take something like today to deploy it. And one thing I'll say on more the rates versus equity volatility side, we've started to see just tails come in. So not a 1 standard deviation drawdown cost of protection, but a 3 standard deviation cost of protection drawdown. That's actually come in, and that had been pretty sticky. So it kind of sounds like maybe people think that left tail is a little bit more off the table now with these negotiations being can-kicked as opposed to more fighting going on.
What brings those tails in further? Is it sort of a little bit more definitive of a cessation or the end of this war, or is there something else that can maybe do that?
Look, I think investors tend to be really bad at pricing geopolitical risk because at the end of the day, we're just not military experts. I think that's why we lean on people who are. But I think if you asked investors, they would say, well, it's the fact that they're talking, which is just very different than they are fighting. And so whether or not that leads to some conclusion, you think about that of why that tail has been removed slightly. I think that is the change that really caused that inflection point versus a few weeks ago when we were simply still fighting.
All right, Amy, always a pleasure. Amy Silverman, equity derivatives strategist at RBC Capital Markets, counting us down to the closing bell with names like Microsoft and Apple out front, pushing the S&P 500, Katie, to what could be another record high.
And I mean, you take a look at the NASDAQ 100 index as well, briefly hitting an intraday high, but looking at a streak of 11 winning days on the NASDAQ 100. That is the longest streak since 2019, Romain.
Absolutely here. A lot of people really are trying to sort of make sure that they are not missing out here as we potentially find a bottom for the big market sell-off. A full breakdown of all of today's market action with our global simulcast. That starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romain Bostic alongside Katie Greifeld, taking you through to that closing bell with the global simulcast. It started. Carol Masser and Tim Stenovic pop up. Welcome to our audiences across all of our Bloomberg platforms, television, radio, our partnership with YouTube here on what looks to be a record-setting day, at least for the S&P 500 and the NASDAQ 100.
It's just for you. It's a little gift to you now that you're back with us.
I already made that joke, Carol.
Yeah. I love that it's a joke. Hey, what NASDAQ 100, what are we up 11 days now in a row? I mean, we continue to see momentum to the upside. Again, we know why, guys. It looks like, it feels like some calm and looks like, once again, this war is progressing. But I got to tell you, we just talked with Brent Schutte over at Northwestern Mutual Wealth Management. People continue to remind us that there are still a lot of things to worry about, and he actually thinks market's getting a little ahead of itself.
Well, the low just at the end of March was around 63.49, Katie. It's up more than 10% in just that short period of time, less than a month. I guess the question is, is this durable? Is it short covering? Some of the reporting has indicated, earlier moves higher have been that. I don't know.
Right. Yeah. I mean, it remains to be seen to the question of sustainability. I will say that this feels like more than a relief rally at this point. I mean, we've clawed back our losses when it comes to the big indexes, and now we're just moving on higher, even though, to Carol's point, there are a lot of big questions out there that have yet to be answered.
Yeah, and particularly when we talk about where sentiment lies right now, I do just also want to draw your attention to the dollar, a weaker, at least against the basket for an 8th straight day here. So that gives you some sense. But of course, the yield story is going to be a big one here as those yields across the curve higher on the day. As for equities, I do want to start out with the S&P 500, 7,022 and change as we wait for these numbers to settle. But no matter where it settles, that is going to be a record high, up about 55 points or 0.8%. A record high for the NASDAQ Composite and the NASDAQ 100, each rising about 1.5 to 1.6% on the day. And the Russell 2000 also getting in on the action, up by about 0.3%. But I do just want to point out quickly, the Dow Jones Industrial Average, the Dow Transports, and the S&P 400 midcaps all finishing in the red here. And that dovetails back with the yield story that there are still some concerns out there with regards to the bottom line for some of those companies most closely associated with the economic cycle.
Well, Romain, Katie's going to do this, and I'm going to just kick it off here, just digging deeper into the index. I mean, you look at the S&P, more names were actually lower today in the trade, 279, Katie, to the downside, 223 to the upside, one unchanged. So, yeah, it's not like investors were rushing out there to buy everything today.
But they were rushing out there to buy tech, which I think is very telling when you take a look at this rally right now. But you're right, you take a look at the sector composition. 4 sectors in the green, 7 in the red, led by tech to the upside, higher by about 2% as a sector. Consumer discretionary, communication services, financials also in the green. In terms of what didn't do too well today, materials down by about 1.3%, industrials, utility, healthcare, some of your biggest losers.
All right, guys, let's get to some of the individual gainers in today's session. I love this story. Tim and I were just talking about it. I think it's among our most read. Allbirds. I don't know if you guys bought them. We did in our home.
Yeah, I once had a pair of those. Whatever happened to those guys?
Well,
Everyone did.
well, apparently,
Whatever happened.
Apparently, they discovered AI.
Oh, cool.
Allbirds no longer all sneaks. Stock is soaring in today's session. Is that right?
It's soared. Yeah, we're closed now.
582%.
That's like a typical daily move for a stock. I don't know why you're questioning that move, Cal.
Yeah, I know. All right. Nicely done.
That happens all the time.
The company inked a deal to sell off its footwear assets back in March. So now Allbirds is now all in on AI. The former shoemaker, just days away from ceasing operations, it's not been easy the last few years, said it would pivot its business to AI compute infrastructure. The company executed a $50 million convertible financing facility, and so they're going to fund the switch as it targets becoming a fully integrated GPU as a service and AI native cloud solutions provider. And it's going to change the name.
Yeah.
Drum rolled. New Bird AI.
Cool.
Okay, cool.
Are you in on it?
I like that they kept the
Well,
bird.
given
Me
the
too.
600% increase and that it now has a market cap of $148 million, no.
You're not all in
No.
on all
Well, we'll see where
New
this
Bird
goes.
AI.
I mean, it's
Yeah.
a bold move, Cotton. We'll have to see where it goes.
Can I just say, it does remind me
Yeah.
of simpler times, and I'm thinking specifically of the meme stock era, because this felt very memey. I felt like I was back in 2021, which was a weird time, but you saw a lot of stories like this.
Katie, we had a show back then
I know. They canceled that.
together. That's how long ago this was.
Was it called the Meme Stock Show?
Oh,
Kind
No.
of.
but we did a lot of meme stocks.
We certainly did.
I used to love that show.
Did you?
Aye.
All right.
Let's move.
All right, let's move along. Snap.
along.
Let's go to Snap, guys. That was also.
Why can't we reboot that? I mean, if they could bring back Scrubs, can't they bring back Crypto IR?
You know, Scrubs, the
Yeah.
Scrubs
This-
reboot was awesome, but it's
Yeah.
not in the
like-
offing for us.
Like herding cats every day.
Yeah, sure thing. You got something
All right.
else, Carol? Or
Yeah,
can we move on?
I always have something else.
All right.
Okay, stock Snap up as much, almost 10% at its highs today, finishing the day with a gain of about 7.8%. This is what happens, I guess, when you lay off roughly 1,000 full-time employees, 16% of its global workforce, as part of an effort by the CEO, Evan Spiegel, to reduce costs and achieve profitability. Job cuts and pullback on hiring will reduce Snap's annualized cost base by more than $500 million by the second half of this year, according to the CEO. He said the cuts are necessary for Snap to
That's
boost.
like 3 Allbirds. Sorry, go ahead.
That's really funny.
Yeah, thank you.
Said the cuts are necessary for Snap to boost efficiency as it pursues profitable growth, citing improvements in AI technology that lets Snap employees move more quickly. And one more for you guys, because, 3 is what we're allowed to do. Hims and Hers Health. That one was up almost 14%, the telehealth firm, climbing after HHS Secretary Robert F. Kennedy Jr. said the FDA is seeking to remove 12 peptides from Category 2 restrictions. What's the matter? Is that a laugh?
No, just
No,
shocked
Tim
silence.
seemed very interested in this, but go ahead.
Well, he actually said I had to do it.
Yeah.
I actually was.
I don't know what the deal is with these peptides. Like, are they safe?
Well, apparently, with the action that they're doing is going to restore regulated access and will immediately begin shifting demand away from the black market, according to our secretary. Post on X.
All right.
You can read about it all on the Bloomberg.
I want to get to some of the stocks that were on the decline today. Live Nation in the news. This story breaking this afternoon. A New York federal jury found that Live Nation Entertainment illegally monopolized the live events industry and overcharged fans. Live Nation shares finishing down by 6.3%. The jury found that Live Nation's monopoly led concertgoers to overpay, and the company illegally tied the use of company-owned venues to its concert promotion services. Once again, shares fell in today's session by 6.3%. It's the lowest that they've been since November of 2025. Romain, you're watching some earnings. I'll do more decliners, but I want to hear the earnings that you're watching.
Yeah, we got a trucking company, JB Hunt, now out with their earnings, and you see the initial knee-jerk reaction in the shares, basically flat. The company did beat on the bottom line, $1.49 EPS. The street was looking for $1.44. Revenue also slightly higher than estimates at about 3.06. We'll round it up to 3.1 billion. That's about a 5% jump year over year. We should also point out, and there's an interesting nugget here in there. They talk about rents and purchase transportation. The expenses there actually did increase. That was up about 9% year over year. And this is going to be an interesting story with a lot of these these trucking and logistics companies, particularly in light of some of the disruptions, Tim and Carol, that we've had with regards to the situation in the Middle East?
Well, speaking of the situation in the Middle East, a couple more stories that have to do with earnings and understanding the consumer and macroeconomic conditions, starting with shares at ASML. Shares fell after the company gave a weak outlook for the current quarter despite raising that full-year sales forecast. The company sees net sales in the second quarter of 8.4 billion to 9 billion euros. The company expects net sales to be between 36 and 40 billion euro this year, increasing production to meet demand from tech firms for its advanced lithography machines. Still, it was seen as conservative. Shares down 2.4% on the day today. And finally, great ticker, DO US, BRP Inc. It's the parent company of Sea-Doo jet skis, Ski-Doo snowmobiles, Can-Am off-road vehicles. Down all day today by more than 35%. That's where it closed. The firm withdrew its financial outlook for the 2027 fiscal year. It says it faces $363 million cost from recent changes by the Trump administration to its tariffs. We actually also saw other companies move lower in sympathy today. Polaris shares actually fell as well. You have one of these side-by-sides, Romaine?
One of these side-by-sides?
Yeah, they're off-road.
No, they're kind of hard to keep in the New York City department. But it gets to this idea, though, too, of when we talk about the tariff threat, and particularly some of the comments we heard from the Treasury Secretary. One reason why you saw transports lower, one reason why you saw a lot of industrial stocks lower. Just real quickly, let's check in on yields before Carol gets antsy here. We did see pretty much a shift across the curve here, up about 2 basis points on the short end, but keep an eye on that long end. 3 basis points on your 10-year, 3 on the 30-year. And that is the big question mark going forward. Katie was referencing this earlier on The Close, a preeminent program on Bloomberg Television, by the way, Carol and Tim. And this idea of that IMF report, and really a lot of concerns right now about current debt levels, the economic ripple effects, and what type of yield investors are going to demand to hold U.S. Treasuries.
All right, now I'm more than antsy. All right, gonna wrap. Thank you so much. All right, that'll do it for our cross-platform. We call it the closing bell.
Romaine's back. That's great.
You know, it's just not the same when you're not here, so it's good to have you back. Radio, TV, YouTube, Bloomberg Originals, we do call it the closing bell. Katie and Romaine finishing up there on The Close on TV. Tim and I right here on Bloomberg Business Week Daily on radio. Folks, we will see you again, same time, same place tomorrow.
And our coverage continues with some breaking news, this involving the automaker Ford, its top executive departing in a sweeping reorganization. Remember, this is a company that had already announced moves to retrench from the EV space, including about $20 billion in charges. And now we're learning that Ford Motors' top electric vehicle executive is leaving his position to pursue undefined opportunities. Joining us right now is David Welch, who leads our coverage out of Detroit. Who is he? Where is he going? And more importantly, David, what does this actually mean for Ford's EV strategy?
So this is Doug Field, who was brought in to basically electrify Ford, build all the EVs that they had planned. And you've seen Ford, you've seen General Motors and others. They've had to pull back their investment in EVs. There have been a lot of big write-downs, and this has gone on for any company that had big electric vehicle investments in the U.S. And I think someone like Doug Field, he came from Tesla, he came from Apple, he worked on Apple's car project. These executives who worked on the West Coast for tech companies, they came to the Detroit companies, and there were a lot of them at both Ford and General Motors, to usher in software-defined vehicles, self-driving cars, and electric drive. And some of that stuff hasn't really panned out. Some of it's still in the works. And Ford's not totally walking away from EVs, but it's not the huge investment, the huge transformation that a lot of people thought it was.
Right.
And I think when that happens, some of these executives decide, okay, I've done my work here. It's not going to get any bigger than this, and it's time for me to maybe look to do something else. And he hasn't said where he's going, but he's certainly leaving Ford.
Yeah, well, you mentioned, his resume there, Doug Field, and certainly it was a watershed moment when he was hired away from Apple in 2021. A good reminder of how quickly things can change in just a couple of years. But talk to us about the EV strategy going forward, because as you mentioned, they're not completely retreating from EVs, and I know that they have that $30,000 electric pickup that's still planned here.
That is still in the works. Ford is also looking at what they call an e-rev. I can't stand the term e-rev. It's basically a very strong hybrid, but it's got a motor on board that'll charge a battery, and people can drive without having to worry about running out of juice because they can fill up on gasoline someplace. So it is sort of a hybrid powertrain. It is a mode of electrification. Ford's looking very strongly at that. But these huge investments that we saw announced over the past 5-10 years, where companies, Ford, GM, investing $25, $30, $35 billion in EVs, people are really pulling back from that because the consumers just aren't there. And that's especially true when the Trump administration watered down environmental rules that sort of forced development of those vehicles and also pulled away the sales incentives for consumers to get them. I think probably those targets for sales and the number of vehicles that we're working on were overwrought to begin with. I don't think we ever needed as many vehicles as the industry was developing. But now we're seeing the real outcome of that, which is people who worked on them are leaving and investments being pulled back and some job cuts happening too.
All right, David, really appreciate your reporting. That is Bloomberg's David Welch taking a look at Ford shares right now, lower by more than 1% in the after-hours trade on news that Ford's top EV executive is departing the company in a sweeping reorganization, Romaine.
All right, our markets did close here in the U.S. just about 12 minutes ago. Let's check real quickly here on what is a record-setting day for the S&P 500 and the NASDAQ, each adding roughly about 1% or so on the day. But what is notable are some of the names that sat out. You saw the Dow Transports as a whole down about 1.5%. Dow Industrials also lower as well. Still some concerns about the tethering of some of those names to the economic cycle, and particularly, as we were just talking about on the simulcast, the reemergence of some of those tariffs that could ding profitability.
Let's get to our top story this hour, and you said it, a return to records. The S&P 500 closing at an all-time high with bulls back aboard the risk-on train. The big banks this week batting down concerns around one of the riskier corners of the investing landscape, private markets, with Morgan Stanley CEO Ted Pick telling analysts this morning that private credit is simply in its adolescent phase. Now, our next guest is an expert on valuing private assets as an advisor to many of the largest PE and private credit managers around the world.
All right, joining us right now is Jake Silverman. He is the CEO of Kroll. Jake, great to have you here on the program. And of course, when we talk about, I guess, the folks that you talk to, and more importantly, the folks that are talking to you, looking for some guidance and advice, what are you hearing? Is there fear? Is there concern? What?
Well, first of all, hi, Katie. Hi, Romaine. Thanks for having me back. Listen, we are in a moment that is, I guess I somewhat agree with Ted Pick's assessment of the state of the market in terms of its maturation period. It's a market that has grown rapidly. It is going through an experience of growing pains, so to speak, in terms of market participants understanding how the market works. And there's plenty of new market participants coming in to this private credit market as it grows. And so what I'm hearing is a lot of chatter, so to speak, that is trying to separate the market reality from market perception. And what we at Kroll are focused on doing is showing the market participants a source of truth. And as we talked about last time, we developed a private credit benchmark that is really meant to show the facts that underlie this evolving and maturing market.
Well, so what is the truth, though, Jake? I mean, we know there's risk out there. I guess the question is sort of, what is the actual measure and whether there's any sort of concern or legitimate concern about contagion. What are you finding?
Yeah. So what we're finding when we look at the Kroll Stepstone private credit benchmarks is that, in fact, risk as measured by traditional leverage and credit metrics has not really increased. And this is through really the end of the first quarter of this year. Key credit metrics like leverage, like interest coverage, have really not increased in any meaningful fashion. And in fact, based on new issue volume that form part of the benchmark itself, we're actually not seeing spreads widen materially across various market sectors. Now, there are idiosyncrasies, of course, and there are certain sectors where we are seeing certain spreads widen. But in fact, we believe that the fundamentals underpinning the market, at least through the first couple months of this year, are sound from a credit and risk point of view.
And Jake, I am curious to hear your perspective on the push that we're seeing to more frequent pricing, more transparency on how these assets are actually traded. You've seen some folks within the space push towards maybe monthly marks, maybe in some cases the ambition is to go to daily pricing. I mean, is that something in your view that is realistic and achievable?
I do, and I think over time the market will absolutely head in the direction of more frequent marks and more volume of marks. And we really are at the center of trying to develop the infrastructure with great in-class GPs who are very active in the marketplace to enable the system to support that type of frequency. We're not there yet. It will take a while. There are certain players who are out there sort of leading the charge in terms of more frequency, but that is certainly a trend that we are seeing as the market develops.
And I am curious to get your thoughts on whether or not, we could see a cycle turn here when it comes to private credit. We heard from JP Morgan CEO Jamie Dimon, of course, this week talking about how we'll probably see a credit cycle at one point or another. And I wonder if, in your view, that's inevitable. And if so, if we do reach that cycle turn, whether or not this big growth, this new interest and these new investors that have entered the space, how that will play out should we actually see that rotation?
First of all, I'm not a market strategist or a market prognosticator. We're here to support the growth of the market. I do believe that whether or not there is a cyclical shift one way or the other, that the secular trends towards the growth of the private markets and the growth in other forms of investors in the private markets will continue. And I think it will continue for years, if not decades, to come. So we believe that the secular growth of the overall asset class and the exposure to new forms of investors will continue to grow. And what we're focused on is making sure that the market infrastructure can keep up with that growth and demand and weather whatever storms might impact a market from time to time.
All right, Jake, really appreciate your perspective. That is the CEO of Kroll. His name is Jake Silverman. Now, coming up, AI's power push. We'll speak with William Thompson. He is Senior Thematic Investing Research Analyst over at Barclays. This is The Close on Bloomberg. AI's energy build-out kicking into high gear. Oracle posting a fourth straight day of gains as the software company agrees to buy as much as 2.8 gigawatts of fuel cell power from Bloom Energy. Now, the move comes as America's aging power system is strained by more extreme storms and now electricity demand growth. Our next guest says, quote, whoever wins the energy race likely will win the AI race. William Thompson, he is Senior Thematic Investing Research Analyst over at Barclays. He joins us now. William, great to have you with us. So let's talk about what that means. Whoever wins the energy race wins the AI race. Does that mean basically whoever can build the fastest?
That's correct. Energy is a limiting constraint on AI. We just hosted our 4th annual Next Gen Energy Conference at Barclays. I would say the main takeaway from the messaging from our panelists were AI is not in a bubble. We're in the early innings of the hyperscaler CapEx spending. The data center market remains very fundamentally healthy. The challenge is a convergence of execution risks. So power being number one, but also labor, permitting and growing NIMBYism, so not my backyard resistance around local resistance, and also insurance got brought up as a limiting constraint around just the power, the data center build out and the financing needs that will come with it.
And I have to imagine a big part of the conversations was, whether or not we're seeing a little bit of an overbuilding going on, because you think about just the physical footprint of what we're talking about when it comes to some of these data centers. It's massive, and you could imagine a future where, that footprint is able to be compressed as, maybe we figure out ways to do all of this a little bit more efficiently in terms of space.
Yeah, the hyperscalers have consistently said that they're short supply. I think we're seeing the convergence of 3i scaling laws that I think investors need to pay attention to. So first, we still need logarithmic growth in compute for AI training to get to the long-term goal of Gen AI. But also on the inference side, right, we've seen this move to reasoning models, now agentic AI, and that's leading to more tokens, more compute per token, and more AI tasks. You converge those three things, there's a massive growth in inference demand. So the convergence of those two things on training and inference is really leading to the shortage of compute capacity. And we continue to hear from the hyperscalers that their challenges around getting power at scale to build the incremental data center.
Well, I'm curious as to when that starts to sync up, because I feel like the data center build out, meaning the actual physical infrastructure, seems to be chugging along. Yet I've seen a lot of reports showing that the time it's going to take to actually get that power online could be a year, maybe even longer than after the actual infrastructure build out.
It takes about 2 years to build a data center, and it could take 5 years. So 5 years to get a combined cycle natural gas plant on grid infrastructure.
Yeah.
3 years just lead time if you order from a GE Vernova or Siemens Energy to get that turbine, but also 2 years to commission it. And we're measuring AI in dog years, right? We think of calendar years and 7 years of dog year. I mean, this thing's happening so fast. Speed to market is so important for the hyperscalers that they're actually bypassing the grid and going behind the meter. And that's been a release valve for actually scaling the data center capacity.
But is there any concern about potential obsolescence? The idea that as this sort of the duration of this build out goes on, that the technology itself, at least as we've seen on the consumer facing side, seems to be growing exponentially. Are they building something that by the time it gets up and running, they might have to say, okay, we've got to rip a lot of this stuff out and start over again?
That's why there's so much emphasis on future-proofing the data center. I think a lot of the older data centers are subscaled. 3, 4, 5 megawatts, it doesn't meet the AI compute requirements of today. So you're seeing these gigawatt scale data centers that are being future-proof in terms of liquid cooling, single phase, two phase. I think they're taking that into consideration because we don't know what the next generation of GPUs are going to come from NVIDIA. And therefore they're trying to anticipate what the infrastructure needs for energy density plus the liquid cooling capacity to meet those needs.
What are you hearing in your conversations about labor? For example, because I mean, Microsoft has identified this as a risk, just, the ideal of skilled labor, whether or not there's enough of it when it comes to this build out. What is the temperature? What is the mood music around that point?
Anecdotally, we continue to hear labor is an issue. It's hard to quantify. Sam Altman said not too long ago that OpenAI's requirements in the next 5 years require 20% of the skilled labor. So we're talking about pipe fitting, electricians, and plumbers. I mean, that's a huge issue. I mean, Brad Smith of Microsoft has also been adamant this is a major concern. So I think it's hard to quantify today, but it feels like my old oil field service days where we were flying people from Houston, North Dakota, paying them per diem. Like, this is a constraint. So we're seeing man camps built in parts of Texas to support the labor constraint. But I think this is a major risk that's one of the convergence of the execution risks that come with us.
I know there's been a lot talked about with regards to the competition that we're seeing amongst these companies. But how much has been sort of considered about our competition, say, as a country, with, say, China, and a build out over there that isn't always as constrained as we are, primarily because of a whole different set of regulations and a government structure?
Yeah, I mean, we're advanced in terms of our semiconductor capacity, but we're behind. They're weaponizing their power capacity, right? They don't have the same rules that we have in the United States in terms of the permitting and easement. So they've done the all-above approach, right? And they've benefited from that. So I think they're going to weaponize their power capacity and try to catch up on the semiconductor capacity. But that's a concern for us.
All right. Well, great to have you here. Will Thompson, Senior Thematic Investing Research Analyst over at Barclays, as we keep an eye here on the AI build-out, which, of course, is to a large degree a power supply build-out as well.
Yeah, and I thought the comments around NIMBYism were really interesting because you think about these data centers, and in many places you're seeing a lot of local resistance, especially when it comes to what it means for energy bills, which we already know are moving higher in many parts of the country. Yeah,
it sort of became a big issue in some of those special elections we had in 2025, and certainly going to be a big issue this midterm. We've seen it a lot. You've seen these town halls, the politicians being asked about it, and let's face it, voters don't always think about maybe the long-term benefits. All they know is what they're paying in terms of their energy bills. Yeah,
they're looking at their monthly bills and saying, this math doesn't quite make sense to me. So
the math isn't mathing for some people.
No, have to imagine that, to your point, this is only going to become louder and louder as we get closer to November in those midterm elections.
Absolutely. Now we're going to pivot from the AI space. We're going to stay in tech with biotech. Eli Lilly set to acquire Crossbridge Bio for $300 million. We're going to discuss with one of the companies helped to incubate that company, Portal CEO John Flavin. He joins us when he comes back after the break. This is Bloomberg. Eli Lilly set to snap up preclinical biotech company Crossbridge. It's a $300 million cash deal as it pushes deeper into cancer therapies. Our next guest is a big investor in this fast-moving corner of the market, and Crossbridge Bio is one of his portfolio companies. Portal Innovations CEO John Flavin, he joins us right now to talk about the latest deal in, well, an area where we've seen a lot of deals. But let's first start off with talking about the technology. And you obviously explain this in layman's terms because we're not as smart as you. But when we talk about these antibody drug conjugates, what exactly do they do, and what has Crossbridge done to develop?
Thanks, Romaine. These are very interesting new kinds of cancer agents, sometimes referred to as a heat-seeking missile. And the way they're set up is The antibody sits at one end of a linker, and at the other end is a chemotherapeutic agent. So one of the challenges in treating cancer historically has been it's very difficult to treat patients with chemotherapy without all the side effects. And that's because historical chemotherapeutic agents go in the whole body, and so they're not specific. In the case, so they're like carpet bombs as opposed to, a heat-seeking missile in the case of an antibody-drug conjugate. Now, with Crossbridge Bio, thanks to two really smart professors at the University of Texas Health System, invented a next-generation ADC. Typical marketed agents, which there's about 15 on the market today, representing about $15 billion in pharmaceutical sales, have one warhead. And in the case of Crossbridge, they have two. And that's what's unique about it, and I think very exciting for what could be beneficial to cancer patients.
All right, so we're talking preclinical here. So how much time do we need where we would potentially see this actually deployed for those who actually need it?
Well, cancer agents can move quite quickly. The company is on the cusp of entering phase 1 clinical studies going after both breast and lung cancer. They were indicating that those studies would start later this year. After phase 1, oftentimes they're able to move into a registrational study. So in the course of the next 3 to 4 years, potentially, this would make it through the FDA, if successful, and treating patients along the way. The beauty of these agents, again, is they're able to provide more chemotherapeutic dose directly inside the tumor, which increases the ability for those tumors to shrink, while at the same time preserving safety.
And so you think about this deal, of course, Eli Lilly and their expansion when it comes to cancer, when it comes to oncology, it certainly fits in with that. But John, I'm curious to hear from your perspective, what are you seeing in terms of, where the interest is for deal making right now? Which areas of drug development, of treatments seem to be catching looks here?
Yeah, well, oncology certainly remains, a very important space, and science is driving new innovation, which is for the betterment of patients. I think it's well documented now that M&A is on fire in biotech and pharma again this year, and it's expected to continue on its current pace. I think right now we're on pace to double the activity we saw over the course of the first half of last year as we look at 2026. So broadly, pharma is trying to refill their drug pipeline because they have a massive $300 billion patent cliff that comes on the scene in 2030.
Right.
And so they're strategically looking for assets, and increasingly they're looking earlier stage and smaller deal sizes. A lot of the deals recently have been below $10 billion in scale, and that kind of opens up the door for a lot more of a pipeline that are earlier in development, a little riskier, but novel science that hopefully will really have a major impact. If you look outside of oncology, obesity, obviously, cardiometabolic disease, type 1 diabetes, those areas remain very important as the population ages.
And I'm glad you brought up deal size, because that's something I've noticed as well, that it's more of these smaller scale acquisitions, these smaller price tags. I'm curious why that is, John, in your view. Is it because, we do have a little bit of time when it comes to 2030, maybe, some of these companies saying, like, we can take maybe a higher risk, less surefire bet right now? Or is it more the idea that maybe those types of deals would be easier to get across and pass regulatory scrutiny?
I think it really has to do with diversification of the strategic platform that these larger companies are seeking to augment their internal programs around. And so as the science gets validated, like in the case of Crossbridge, they're able to move in and move very quickly with their large infrastructure to accelerate the development, both manufacturing and clinical studies of these compounds. And so I think as opposed to doing massive deals, such as Pfizer a couple of years ago with Seagen, there's a lot more selectivity around a number of deals, diversifying the risk profile, more shots on goal, and being able to increase the overall portfolio of revenue success once these agents hit. I will say, too, that these types of drugs are a little bit more understandable as they enter into and through phase 1 clinical studies, especially in oncology. And because of that, they're a little less risky to develop with regards to the targets that they're going after.
When we talk about drug development, particularly in light of some of the funding cuts coming out of the federal government, a lot of the pullbacks that we've seen from certain universities, are we seeing sort of the major hubs that I guess we would typically look to, primarily like in the Boston area? Has that shifted to other areas, John?
Well, you're seeing definitely more locations benefit from what I would call talent migration. There's a lot more interested professors and faculty going to other parts of the country, Houston being one of those places. As NIH funding has become less certain under the current administration, that has caused some states to step up. In the case of Texas, for example, they have a fund called the Center for Prevention Research Institute, CPRIT for short. They invested $17 million into Crossbridge and several other companies, about $4 billion in total. So where NIH is pulling back, states in certain cases are increasing their focus, and that is then incurring and pushing around more local innovation in spaces that perhaps are not as concentrated in places that were typically the hotspots for innovation. So I think those places, Boston, Bay Area, will continue to flourish, but it's spreading to other parts of the country and even other parts of the world.
Well, everything is bigger in Texas, and you mentioned that you are seeing more states like Texas sort of step up here as NIH funding becomes less reliable. Is that enough, though, to sort of plug that gap?
Well, I think, if you look at the opportunity with regards to the pipeline of intellectual property coming out of universities that have benefited from the long investments made by NIH over time, I think we're in a good position for the next couple of years. I think if the funding continues to be uncertain or is pulled back even further, that creates a bigger gap. But I think for the moment, as states step in and focus on what's local to them and leveraging their academic industry partnerships, much like you're seeing with Eli Lilly, in going to Texas to access innovation and building from there, I think you're going to see a lot more of those types of things happen in the near term. Certainly over the long term, we need NIH funding to continue to invest at a robust pace. But I think people are looking beyond that with regards to where the current administration stands, both in terms of FDA and NIH funding.
All right, John, it's great to get some time with you. Our thanks, of course, to John Flavin. He is Portal Innovations CEO. Let's take a quick look at how markets closed on the day, and it's a beautiful thing, Romaine Bostick. The S&P 500, the NASDAQ 100, both closing at fresh record highs. For the S&P 500, we haven't seen that type of action since all the way back in January.
Not to throw cold water on it, but I'm going to throw cold water on it as well.
Go ahead.
About half the stocks in the S&P, more than half the stocks in the S&P 500 were in the red. You did get a big boost today from your Microsofts and Apples and those kind of names here, but it raises questions here about why we didn't see a little bit more of mine on the cyclical side, and you see that kind of reflected in the drop in the Dow Jones Transportation Average.
I have to say, I think you keep a closer eye on the transports than pretty much anyone else here at Bloomberg.
I like trucks, Katie Greifeld. Tractors, trucks,
well,
airplanes.
Should we flip up to the next board? Because
there's a second board.
I have a JB Hunt for you right now.
Wow.
Of course, they reported after the bell, JB Hunt, and shares a little bit higher, 1.5% when it comes to that trucking company. Can't say you're seeing the same when it comes to Ford. Of course, Bloomberg News breaking the story that their top EV executive set to depart. This is The Close on Bloomberg. Netflix set to report results tomorrow, giving investors a glimpse into the streamer's future after walking away from a battle to acquire Warner Brothers Discovery. Our next guest says that Netflix is spending less and charging more, which is a perfect formula for profit growth and higher free cash flow. Joining us now is Michael Pachter. He is Wedbush Securities Managing Director and Equity Research Analyst. Great to have you with us, Michael. And I have to imagine there's going to be a lot of eyeballs, a lot of ears paying attention to any commentary on that decision to walk away. But talk us through some of the fundamentals here, when it comes to the fact that Netflix has been able to raise prices. In fact, they just did so again last month. Not that it'll be reflected in this quarter, but how does that all set us up for tomorrow?
Well, it won't be reflected in the March quarter, but definitely they're going to blow out consensus numbers for the June quarter. So, they're going to revise numbers upward. That's good. I think people will be happy with that. You're right about a glimpse into, their future strategy. I doubt that they will dwell on the Paramount Warner deal, but I think that they were saved by Paramount coming in. I think that Netflix would have been distracted for many, many years trying to figure out what to do with those assets, sort of like the dog that catches the speeding car and now is racing along, hanging onto the bumper for dear life. I'm not sure that Netflix could have actually pulled that off or actually made any money out of that deal, and it would have really dramatically changed their business model. They would have been suddenly owners of a lot of iconic IP and kind of on the hook to exploit that. So I don't think they'll talk about that. The key really is the price increase. They raised prices about 10% in the U.S. and Canada. You'll see that ripple through other regions in the next quarter or two. And consensus only has price or revenues going up by about 5%. There's zero price elasticity on this. We just did a survey on it. Nobody even knows. Nobody cares. So I think that they're not going to lose subscribers. People who care about the price will trade down to the ad-supported model. We'll get a little bit of data on whether they're generating enough in ads to be at parity with a full-price subscription without ads. I think the answer is yes. So everything is clicking, really working well there.
Well, I hear what you're saying, that, the company probably isn't going to talk too much about that decision to walk away. But if we were to dwell for just a little bit longer here, I mean, what do you make of their overall appetite for M&A now that, they, as you phrased it, were saved from doing that deal? Do you think that they're going to go out and pursue another?
I do. I don't think it'll be what you expect. I mean, the movie and TV production studios are pretty sparse. I mean, there's Lionsgate, and it's really not a great company. It's been for sale for about 15 years, and if they want to buy it, they can. They missed by not really bidding on MGM. They missed by not really bidding on Fox. So, Warner was the last big one. There might be some assets out there, but what I really think you're going to be surprised by on their M&A is games. And think about games differently than what Netflix has been saying in the past. They've been talking about augmenting their subscription offering by giving people free access to games. So they were going to give you premium game experiences as part of your subscription. They're going to shift that. They hired a guy who actually gets it. First time in a long time, a guy named Alain Tascan, French guy. He's actually in Paris right now. I was texting with him this morning. And he is brilliant. And he looks at this completely differently. He is going to turn Netflix into an entertainment platform, and games is going to be one of the anchors of that platform. So think about Netflix suddenly putting Fortnite on the platform and capturing 30% of whatever people spend in Fortnite on their platform. Out of nowhere, Netflix is probably going to see revenues rise by $100 million a month. I mean, something like that is going to happen. Think about Netflix as a destination to subscribe to HBO. Why not? Why not click on the HBO icon when you boot up Netflix and watch an HBO show, and when it ends, you're right back on your Netflix landing screen.
I am curious.
They're going to do that.
I'm curious.
I think you're going to see massive growth in revenue and profit. Sorry, I mean.
I'm curious just on the gaming side, though, too. I mean, so you think they're going to rely more on existing franchises coming to the platform rather than trying to sort of partner with on something new?
No, both. I think that they will. I think they have to establish a beachhead. So, the easiest thing for them to do is emulate what Apple does with iOS and just say, we're an open platform. We're going to offer connected TV games. You don't need a computer to play games, and put something like Candy Crush on there. Candy Crush is slow twitch. It's not player versus player. You're not shooting anybody. And guess who owns that? Microsoft. So if you read the article and the information on Asha Sharma, Greg Peters acknowledged he's talked to her. What are they talking about? Let's put Candy Crush on Netflix. And if Activision gets more people playing that game and spending more money, Activision, Microsoft makes money. So they're really happy. And if Netflix customers never leave the platform when they go to play Candy Crush, they're happy. So I think you're going to see deals like that first. Then I think they'll develop some exclusives to keep you on the platform, make it stickier. But I think they're past this concept that they have to offer you a $50 or $60 game for free. That's a money loser. That costs them money. I think they're on to the new concept. We can offer you a free-to-play game with in-app purchases, and that'll keep you on the platform as well. And that's what people do on their phones. Why not do it on your TV?
I do want to ask you real quickly here, Michael, just about the idea if we are sort of moving to a Netflix that is much more, where the focus is going to be much more on that cash flow generation, do you think we would see an increase in buyback programs or any sort of return of cash to shareholders?
Well, I mean, they have 4.5 billion shares, and a $100 share price. So, their cash generation is about $11 billion. So, what can they buy back? Not very much of their stock, a couple % a year if they spend it all. But yes, when I said they're spending less, they've kind of quietly gone from a new movie every week, so over 50 to 25. And I think next year 20, and the next year 15. I think they finally recognized that they're just not making any money if they don't have theatrical exhibition. So that's one way to save money. Price increases are working because they're giving people more. The last leg of the stool is give us all of our entertainment when we log on to Netflix. Why isn't Spotify there? Should be. Why don't they have video on demand movies? Should be. But they don't do it. They will. So I think that it starts with Alain Tescan talking them into putting free-to-play games on there, and I think it finally peaks when they offer you everything and you look at Netflix the way you look at your iPhone.
All right, Michael, always a pleasure. Michael Pachter, Wedbush Securities Managing Director and Equity Research Analyst, with a close eye here on Netflix earnings, which we will cover right here on The Close, just a little less than 24 hours from now. Meanwhile, just a little more than 12 hours from now, we're actually going to get earnings out of another important company, and that is PepsiCo. Should we expect shares to pop or fizzle? Joining us right now to talk a little bit more about this is Ken Shea over at Bloomberg Intelligence. We're basically talking about a roughly 6% revenue growth side, $1.55 on the bottom line. But before we get there, Ken, I got to talk to you about Doritos, because really the story that I think everybody on the Bloomberg terminal was talking about last week were some of the price cuts that Pepsi is employing after not necessarily, I guess, reading the room when it comes to what people can afford. Are some of those price cuts, have they already been implemented? And more importantly, are they going to affect the bottom line for the most recent quarter?
Hi, Romaine. Well, you asked the million-dollar question. Yes, they have been implemented, and this report's going to give us a good guide in terms of perhaps the early stages of what it means to sales, market share, the kind of returns company can get. This company's embarking on the so-called flywheel strategy. That is, cut some cost, reinvest it in the top line, and there you go. And that's what the company's really embarking on in a big way. I think they really went out of their way over the last few months, starting with the fourth quarter last year, to convince the street that, look, we get it. We were too reliant on pricing. We got to move the volumes up, and we're going to make our products more affordable, right, and we're going to add value through innovation. And so this will give us a good roadmark where they're at.
And Ken, we only have about a minute left, but compare and contrast here, what you're expecting to hear from the beverage makers, the soft drink makers, versus, what we might hear from, those companies that make alcohol, for example.
Well, the soft drink companies are really poised to do better than the alcohol companies. That's just the trends that you're seeing. The Gen Z is not drinking as much as their parents and grandparents. You have the GLP-1 crowd is shying away, and so on. Cannabis is encroaching. Well, the soft drink companies are just powering ahead. I mean, they're ubiquitous. They're everywhere, every channel. And they're still popular. And so these companies are capitalizing on that, and they're adding more functionality, fiber, protein, convenience, advanced hydration. These companies are getting it. Not only are they convenient and affordable luxuries, but they're adding functional benefits that people are looking for. So they really have all those things going for them.
All right, Ken, appreciate you taking time for us. Ken Shea over there at Bloomberg Intelligence. And we should point out, Netflix shares have actually fallen on the day after their earnings for each of the last 3 quarters, while Pepsi's have actually risen in each of the past 3 quarters. Though we should point out, Netflix's outperformance since its last earnings report definitely trumps Pepsi. Are you a Doritos person?
Not really.
Well, we're going to find out at 6 a.m. tomorrow. We're going to set you up for more for what to watch when we come back. All right, let's set you up here on this record day for the U.S. stock market and what investors will have their eyes on over the next 24 hours. That includes some earnings pre-market. We were just talking about it. Pepsi set to report at about 6 a.m.
Yeah, also BNY Mellon. Aftermarket, things get really interesting. Going to hear from Alcoa, but also going to hear from Netflix. Certainly a lot to dig into there.
You just kind of glossed over Alcoa. You're not into aluminum?
Not as much.
All right, may not be as scintillating as Netflix. Of course, we will have full coverage right here on The Close when those Netflix earnings break. We're also going to get jobless claims, those weekly numbers before the morning, and industrial production. That could be interesting at 9:15 Eastern time.
Certainly, and we're also going to have some Fed speak peppered in there as well.
I
Going
missed
to hear
this while I was gone.
from Myron and Williams.
Yeah.
They're going to have a lot to say.
I did not hear any Fed speak. Myron and Williams.
Yeah.
I'm sorry I missed that. Of course, we will have full coverage on anything they say that does move the markets. For all your political coverage, stick around. The team at Balance of Power is up next.